Imagine you have $10 million in cash just sitting right there on your desk.
Oh, wow. That is a massive pile of capital.
Right, just an intimidating amount of money. But there's a huge catch here. You cannot put a single cent of it into the stock market.
None of it.
Nope. No digital numbers on a screen, no, abstract tech startups, definitely no crypto.
Yeah.
You have to take all those millions and anchor them into the physical world around you.
Man, that really forces an entirely different perspective on your daily commute, doesn't it? You stop seeing buildings and you start seeing, financial engines.
Exactly. And that is the exact mindset we are adopting today. Welcome to the deep dive. We want you to stop driving past a pizza joint or like an auto parts store or just a fenced-off empty field and start looking at them as highly engineered vehicles for wealth.
Yeah. And to figure out how to actually navigate that physical landscape, we are tearing into a really fascinating piece of source material today.
We are. It's a curated commercial real estate newsletter from Eureka Business Group. It was sourced by their managing principal, Joseph Goslan, and this is dated March 14th, 2026.
And, on the surface, if you just glance at this thing, it reads like a simple catalog of properties for sale in the Dallas-Fort Worth area and a few beyond. But underneath those listing prices, it operates as a masterclass in how institutional investors evaluate risk, engineer value, and, predict the future of a city.
So our mission today is to decode all the high-level jargon in this newsletter. We're talking about acronyms like NN, metrics like cap rates, and the hidden mechanics of commercial leases.
Right.
We want to extract the underlying strategies that make a property actually worth your money, whether we are dissecting, say, an entry-level building under $2 million or underwriting a massive, sprawling retail complex over $10 million.
Because the mechanism for generating a return on a tiny drive-through is fundamentally, structurally different from the mechanism for an empty pasture.
Yeah, entirely different. So let's start with what I'm calling the illusion of safety. Looking through the properties they list under the $2 million mark, the overarching strategy for an investor seems to be entirely about avoiding headaches.
Just playing it safe.
Right. Take the Pizza Hut in Midland, Texas. It's a 1,963 square foot single-tenant retail building, and the newsletter highlights an absolute NNN lease with 0 landlord responsibilities, over 7 years remaining, and it offers an 8% cap rate.
Okay.
So an absolute NNN lease based on that 0 landlord responsibilities line is that basically like owning a golden goose, but the goose is legally obligated to pay its own vet bills and fix its own coop.
That is, honestly, that is probably the most accurate analogy for it. NNN stands for triple net.
Okay.
The 3 nets are property taxes, building insurance, and common area maintenance. In an absolute NNN lease, the tenant, so in this case, corporate Pizza Hut, pays for absolutely all of it.
Wow. All of it.
Every single dime. If the HVAC system completely dies in the middle of a triple-digit Texas summer, the tenant writes the check to replace it. If the roof caves in, the tenant fixes it. You, the investor, you simply check your bank account for the rent deposit.
That sounds incredible. But okay, so a cap rate is basically my unlevered yield, right? It's the return I get if I buy the place in cash. But what does an 8% cap rate actually mean for your bank account if you bought this property today?
Let's do the math on the mechanism there.
Yeah.
Cap rate is short for capitalization rate. It's the ratio of the property's net operating income, or NOI, to its purchase price.
Right.
So if you bought a building for exactly $1 million in cash and it operates at an 8% cap rate, that building generates $80,000 a year in pure net operating income.
Okay, got it.
It is the great equalizer metric. It allows you to compare, say, the cash flow of a Pizza Hut in Midland, Texas, directly against an office building in downtown Seattle on a totally apples-to-apples basis.
But if I'm just buying a building for the guaranteed corporate income, why does the physical dirt even matter? Contrast that Pizza Hut with another property in this under $2 million tier. There's a Jack in the Box in Houston.
Oh, yeah, the Houston one.
Yeah, it's a bit bigger, 2,573 square feet. It's also an absolute NNN corporate lease. But the newsletter highlights very specific physical attributes.
They do?
They point out it's on a signalized hard corner. It's a drive-through QSR, which is a quick service restaurant, and it sees nearly 53,000 vehicles per day. If the corporation is guaranteeing the rent anyway, why are we obsessing over the traffic light?
Because even corporate giants can bleed cash and close underperforming stores when a lease naturally expires.
Right.
Yeah, that Jack in the Box lease might be ironclad today, but you have to underwrite for 10 years from now. Investors look at 53,000 vehicles per day And a signalized hard corner, meaning a traffic light, physically stops cars right at your entrance.
Which creates that friction-free access.
Exactly. They see intrinsic real estate value in that. If Jack in the Box ever vacates, that physical location is so prime that finding a replacement tenant will be highly competitive. You are buying the dirt's unchangeable geometry just as much as you are buying the building.
But there is a fatal flaw in a flat, multi-year lease.
Right.
Inflation.
Oh, absolutely.
If your tenant's rent stays the exact same while the purchasing power of the dollar weakens, you are actually losing money in real terms.
Which is terrifying for an investor.
Right, and I think that's why an investor looks for a property like the Grand Prairie Napa Auto Parts store. This one is 11,380 square feet. It has the corporate guarantee. It's a top 10% performing store. It has a brand new roof. But the real lever here is the 4% annual rent bumps.
Yeah, those 4% annual rent bumps are the mechanical solution to the inflation problem. They are basically the holy grail for a passive investor.
Because it just scales automatically.
Right. If you sign a flat 10-year lease, inflation silently eats away at your actual return every single month.
Well,
But with guaranteed 4% annual increases written directly into the contract, your net operating income compounds automatically.
wow.
Combine that compounding growth with a new roof and a corporate guarantee from a top-tier location, and you have mathematically engineered an extremely low-risk, self-insulating income stream.
But safety has a ceiling, doesn't it? If that under $2 million tier is all about playing it safe and locking in passive income, the strategy completely inverts as we move up in price. In the $2 to $5 million tier, instability and literal dirt become the primary selling points.
Yeah, this is the transition from buying existing cash flow to actively creating wealth.
So take the Roanoke, Texas Industrial Flex property. It is 16,800 square feet. It features fully built-out offices with air conditioning and outside fence storage.
Yeah.
But the very first bullet point they list under why we like it is short-term leases. I need you to explain this to me because it sounds completely backwards. Why would an investor intentionally seek out tenants who might just up and leave next month? Doesn't that destroy the predictability we just praised?
It destroys predictability, sure, but it unlocks control. This is the core mechanism of the value-add strategy.
Okay, value add.
Right. When you buy a building with a 10-year lease, the value is frozen. You cannot change the income. But a short-term lease acts as a reset button.
Oh, I see.
A new buyer can step in, let those leases expire in a few months, make targeted improvements to those AC offices or the fenced storage yard, and immediately blast the rents up to current higher market rates. The instability is the precise mechanism that allows you to force the property's value upward.
They also note this Roanoke property is an owner-user opportunity. How does that change the math?
An owner-user scenario is really fascinating. Imagine you own, say, a plumbing logistics company. Instead of renting a warehouse from someone else, you buy this Roanoke property. You let the current short-term tenants finish their final few months, and then you move your own plumbing business into the space.
So you are now effectively paying rent to yourself.
Exactly. Your business expenses are paying down your own commercial mortgage, building your own equity, rather than paying off a landlord's mortgage.
Now, they do throw in one highly secure play in this tier. There's a brand new 2025 construction Dollar Tree in Oklahoma with a 10-year lease and a 7.25% cap rate.
Just a little reminder that safe plays still exist at this price point.
Right. But the real aggressive shift here is the pivot to raw land. They list 6 acres of unrestricted land in McKinney, Texas, and roughly 38 acres of residential zoned land in Cedar Hill. Let's dissect the McKinney dirt.
Let's do it.
The newsletter highlights US 380 frontage of 383 feet. It explicitly states it is in the McKinney ETJ, and it's on DFW's hottest growth path. What is an ETJ, and why is an investor parking millions in an empty field?
Well, when you buy raw land on a growth path, you are basically playing municipal chess. You are buying the future layout of a city before it even exists. ETJ stands for extraterritorial jurisdiction.
Okay, what does that actually mean?
It means the land sits just outside the official current city limits, but it is within the legal boundary the city has designated for its future expansion and annexation.
So it's directly in the crosshairs of municipal growth.
Precisely. Being in the ETJ is a strategic sweet spot. It usually means you face significantly fewer zoning restrictions right now, which is why they call it unrestricted land. But you are directly in the path of the bulldozer of progress.
And what about that frontage?
That 383 feet of highway frontage is the crucial metric. Frontage is how much of your dirt physically touches the main artery. You aren't buying this field to farm it.
Right, you're not growing corn.
No. You are buying a highly visible choke point, waiting for the city to sprawl around it so you can sell it to a major commercial developer for a massive premium.
Wow. We have gone from single tenants fixing their own roofs to leveraging short-term leases for forced appreciation to playing demographic chess with unrestricted dirt. But what happens when you leave single properties behind entirely? In the $5 to $10 million tier, we are looking at massive, multi-tenant retail ecosystems.
And when you build an ecosystem of multiple stores, you need something heavy to anchor it. You need a source of gravitational pull.
Let's analyze the Humble, Texas Retail Center to see that gravity at work. It's over 23,000 square feet, surrounded by neighborhoods with a $120,000 median income, with roughly 30,000 vehicles passing by daily.
Great demographics.
Great. But the true engine of this property is the anchor tenant, which is an HCA Houston ER, a 247 urgent care facility.
That is a masterclass in selecting an anchor. Just think about the mechanical function of an urgent care center in a retail strip. It is completely recession-proof, and more importantly, it is utterly immune to e-commerce.
Yeah, you cannot get physical stitches via an Amazon delivery.
Exactly. An ER creates a massive, predictable, nonstop flow of desperate, immediate foot traffic, day and night. The smaller adjacent tenants in that center, maybe a specialized pharmacy, physical therapy clinic, or a coffee shop, they survive by capturing the overflow of that gravity.
A halo effect.
Yes. The ER generates the human presence, and the smaller stores monetize the secondary spending.
Speaking of monetization, the Allen, Texas property in this same tier completely stopped me in my tracks.
Oh, the below-market rents one.
Yes. It's 20,671 square feet in an affluent submarket. It is directly across the street from a Kroger-anchored center, so it's catching the overflow gravity of a massive grocery store. But the listing highlights that it is 100% leased, while simultaneously featuring rents below market.
Right.
If I'm spending millions of dollars on a fully leased building, isn't cheap rent a terrible thing? I'm leaving money on the table on day one. Why is this advertised as a positive feature?
It feels totally counterintuitive, I know.
Ew.
But advertising below market rents is the ultimate dog whistle to a sophisticated, aggressive investor. Think of those below market rents like a massive concrete dam holding back a reservoir of cash.
Because eventually the leases have to expire.
Exactly. When an investor sees a fully occupied building with cheap rent, they don't see a poorly performing asset, they see trapped equity.
Ah.
As each of those old, cheap leases comes up for renewal over the next 3 to 5 years, the new owner can simply open the floodgates. They adjust the rent up to the true, current market value.
And remember our math on the cap rate earlier? Commercial property value is mathematically derived directly from its net operating income?
Yes. If you increase the income by raising the rents to market rate, you force the total valuation of the building to skyrocket without having to swing a single hammer or pour new concrete.
You are literally buying a mathematical certainty of appreciation just by updating the paperwork when the time comes.
You are unlocking the reservoir.
Which brings us to the true heavyweights, the $10 million plus tier. They list a massive 143,000 square foot retail center in Wichita Falls, anchored by a top 10% performing Hobby Lobby, trading at a 7.75% cap rate.
That's a huge asset.
And then there is the Richardson retail portfolio, over 42,000 square feet, 100% leased. But at this price point, the data they use to sell the property shifts dramatically. They barely talk about the buildings.
No, they don't.
Instead, they highlight its location on US 75 with 263,000 vehicles per day. They emphasize that it is located in a dense telecom corridor, boasting over 130,000 jobs and an average household income over $136,000.
Because at the $10 million plus level, you are no longer underwriting a building or a specific tenant. You are underwriting a macroeconomic engine.
Break down the mechanics of that. How does an investor underwrite 130,000 jobs?
Well, when you buy a massive portfolio in Richardson, the survival of the individual sandwich shop or boutique in your center is almost irrelevant. Yeah. You are betting on the structural integrity of the telecom corridor itself, compared to a town that relies entirely on a single automotive manufacturing plant.
Okay, sure.
If that plant closes, the entire local economy collapses, and your retail center goes vacant. But the telecom corridor represents 130,000 diversified, high-paying tech and communication jobs. That density of wealth creates an incredibly thick layer of economic armor.
So even in a recession, the baseline consumption remains high.
Precisely. 130,000 secure jobs means a guaranteed baseline of people who need to buy lunch, pick up dry cleaning, and spend disposable income. 263,000 vehicles per day is not just a traffic metric. It is a literal artery of commerce, pumping consumers past your asset.
So at this scale, you are buying a piece of the region's GDP.
You really are.
Which makes for the perfect transition into the final piece of the puzzle. Because up to this point, we have analyzed all these specific deals as if they exist in a static vacuum.
Right, which they don't.
Exactly. To truly understand how a commercial broker operates, we have to look at the economic weather report they included at the very end of the newsletter.
The micro details mean nothing without the macro context.
So they include a graphic for the Eureka Retail Velocity Index for the Dallas-Fort Worth market, dated February 2026. The score is 5.7 out of 10.0. And right below that, it shows a drop of 0.8 month over month. The newsletter explicitly notes this is a softening from prior month.
Yeah, that's a big deal.
We just talked about all these properties, from the raw dirt to the below-market Allen Center to the massive Richardson portfolio, and they all sound like bulletproof investments. But how does a dropping, softening velocity index change the mechanics of a deal?
A softening retail velocity index is a crucial warning light on the dashboard. It measures the speed at which physical retail spaces are being leased. If it's dropping, it means the machinery is slowing down.
Okay.
Tenants are taking longer to sign contracts, businesses are pausing their expansion plans, and demand is cooling off.
So it takes longer to fill a vacancy. Now, earlier in the newsletter, back in the under 2 million tier, there was a listing we haven't touched on yet. The McKinney Gym.
Oh, the medical office space?
Yeah, a 2,900 square foot space. They noted two very unusual things about it. They stated it is selling well below county assessed value and that owner financing is available. Why would a property owner voluntarily act like a bank for a buyer?
That softening velocity index we just discussed is the exact mechanism driving that behavior.
Really?
Yeah. When the broader market begins to slow down, traditional lenders, the big banks, they get spooked. They tighten their lending criteria or interest rates become unmanageable for average buyers. By offering owner financing, the seller is completely bypassing the traditional banking system.
So they are lowering the barrier to entry.
Exactly. They are adapting to a softening market by making it mechanically easier for a buyer to close the deal. Dropping the price below the county's assessed value and offering to carry the note themselves is how a highly motivated seller pushes a deal across the finish line when the macro environment is throwing up roadblocks.
So a softening market forces sellers to get highly creative with their financing. But how does that 5.7 index score shift the psychology of the buyer?
It radically alters their risk appetite. Remember that brand new Dollar Tree lease we talked about?
The safe play in Oklahoma.
Right. In a booming market with a high velocity index, an aggressive investor might pass on a safe 7.25% cap rate because they want to chase massive forced appreciation with value-add properties. They want to buy half-empty strip centers and fill them up.
But when the market softens,
Trying to lease up a vacant building becomes incredibly dangerous. Suddenly, the boring, unsexy predictability of a corporate-guaranteed 10-year lease looks like the safest harbor in a storm. The velocity index dictates which strategy is viable.
we have dissected an incredible amount of strategy today. We explored the physical landscape of wealth, starting with the mechanical safety of absolute NNN leases, where giants like Pizza Hut take on all the liability while the investor collects an inflation-protected check.
Yep.
We examined the aggressive value-add tier, where short-term leases act as reset buttons and below-market rents are actually dams holding back reservoirs of trapped equity.
We scaled all the way up to the $10 million tier, underwriting the macroeconomic gravity of urgent care centers and massive regional employment corridors.
And we anchored all of it against the reality of a softening retail velocity index.
It just proves that commercial real estate is never just about the physical bricks. It is an intricate web of lease mechanics, demographic shifts, and macroeconomic timing. The buildings are just the physical manifestation of the math.
So as you look at your own daily commute tomorrow, I want you to mull over a final thought that extends beyond this newsletter. We saw that the Dallas-Fort Worth Retail Velocity Index is softening. Leasing speed is dropping. If that trend continues and businesses hesitate to sign new storefront leases, what does that mean for the other side of the physical economy? If the retail storefronts are struggling to fill vacancies, what happens to the massive million-square-foot distribution centers and warehouses that supply them?
That is a fascinating question.
If the front end of the physical supply chain is slowing down, is industrial warehouse space the next domino to fall, or does it become even more critical as a storage bottleneck? Think about where the physical supply chain goes next and where you would park your millions.